In this lecture, I will go over life cycle costing, which falls into syllabus area B of ACCA paper Performance Management. So what is life cycle costing? Life cycle costing is one of the advanced or modern or specialist management accounting technique that applies the concept of product life cycle and calculates the product cost over entire life cycle. Now, after a couple of slides, I will explain you this concept of product life cycle. Unlike traditional method of periodic costing, where costs for one period, generally a year, are matched with revenues of one period, life cycle costing accumulates the revenues and costs over entire life cycle and match them to calculate life cycle profit or life cycle loss. Now that means that traditionally we have been using periodic costing, but now this technique, life cycle costing, has been developed to remove the limitations of the periodic costing. So before we understand the dynamics of life cycle costing, we need to recap features of periodic costing and its limitations. Under periodic costing, as I told you before, costs are accumulated over a period, usually a year, and then matched with revenues to find out periodic profits. Now, one of the reasons we use periodic costing is because costing ultimately feeds the financial statements. So in financial statements, we need to prepare financial profit and loss statement and balance sheet for a period. So there is a concept of timeliness. We need to prepare a financial statement for a certain period. So because we need to prepare financial statements for a period, which is usually 1 year, we need to have it backed by the costing information. So we need cost of sales for the period. So that is why traditionally we are using periodic costing, where we accumulate all the costs over a period of time. So we prepare cost of goods manufactured and sold statement for 1 year. Now, once we use periodic costing and we accumulate costs for a period and we match it with the revenues for the period and we calculate profit and loss, such kind of analysis has problems, because we all know that for every product in initial periods, there are generally more costs than the revenues. So in the earlier periods, product is struggling, we are trying to capture the market, we're introducing the product, there are few customers, the cost of production is high. So cost is more, including the research and development costs, and as compared revenue is less. Now that will result definitely initial product losses, and those losses may cause serious concerns to the managers about the product viability. And managers may discontinue the product without realizing that future profit may compensate the losses. So what's the problem? Problem is that by using life cycle costing, we might come to a situation where, because of the periodic nature of the concept, we are not looking into the future effectively. So periodic costing then results in wrong pricing and making a company uncompetitive, because periodic costing does not allow managers to see beyond the current period, and thereby result is myopic view of costing. So there is a narrow view of costing, because if the cost is high initially or in initial periods, it could be low in the future periods. If the revenue is low in the initial periods, it could be high in the future periods. So by focusing on the present and the current period, we are not considering the future costs and future benefits, and that is a major limitation of periodic costing. It does not consider what comes ahead. It does not consider future costs and future revenues. So in order to remove the limitations of the periodic costing, the concept of life cycle does not focus on current period. Rather, life cycle costing estimates the cost for the entire life cycle of the product and matches it with the estimated revenues from the entire life cycle of the product. Now, how I do it, obviously I need to explain in the future slide. But for a moment, we are saying is that life cycle costing concept accumulates both costs and revenues over the life cycle of the product. So let's say if a product's life cycle is 10 years, Then we need to accumulate costs for the 10 years, all the costs, marketing costs, production cost, and we need to accumulate all the revenues for 10 years. And then we compare life cycle revenues with the life cycle costs in order to see whether the product is having a profit over its life cycle or not. So once we estimate the product life cycle cost and product life cycle revenue, we can estimate whether the product would be profitable or not over its entire life cycle. And by knowing that whether the product is going to be profitable or not over the entire life cycle, we can devise various strategies which we can then apply to increase the life cycle return. Now, life cycle return is the difference between life cycle revenue and life cycle cost. So if life cycle return is less, then we can devise some strategies to increase the life cycle return. Because remember, now the whole technique we are applying now based on the estimates. So what we will do is we will estimate the life cycle cost and life cycle revenues, and by comparing the estimated life cycle revenues and life cycle cost, we got the estimated life cycle return. And if there is no return and if there is little return, then because we have not yet launched the product, we can still change the cost, we can still control the cost, and we can still redesign the product, and we can still increase the life cycle return. So that's the beauty of life cycle costing. It gives us early signals of what we need to do. Before we understand the mechanics of life cycle costing and how we can apply the concept of life cycle costing, the central concept of this is the product life cycle. So we should understand what is the product life cycle and what are the stages in the product life cycle, and then we are better able to relate this concept with the concept of life cycle costing, which is entirely based on this concept. So what is the product life cycle? The product life cycle is the process a product is developed and goes through from when it is first introduced into the market until it declines or is removed from the market. So basically, every product goes through a cycle, and the cycle begins when the product is being developed, and then it is introduced, and then it goes in the market, and then it ultimately removed from the market. So there is a cycle. Now this cycle has 5 stages. The first stage is research and development, and then it goes into introduction, then growth, then maturity, and then decline. In the next couple of slides, I will go through each stages individually and explain the features in that stage and the various costs and the cost behavior and the revenue behavior in those stages. While some products may stay in a prolonged maturity stage, all products eventually phase out of the market due to several factors, including saturation, increased competition, decreased demand, and dropping sales. So every product has to go through that cycle where the product ultimately wiped out from the market. So let's go through the stages of the product life cycle in the form of a diagram, so you can see that first the product is being in the product development stage. So you can see 2 lines here being drawn on this diagram. One is the profit line, whereas the other is so one is the profit line and the other is the line for the revenue. So in the product development phase, there is no revenue. We can see from here, and because there is no revenue and still there are costs, we can see that our profit line is below 0, which means we are incurring losses. So obviously the first stage is the product development phase, where we are incurring a lot of research and development cost, and still product is not yet introduced into the market. So obviously there is no revenue, there are costs, so the profits is going to be like negative. We are incurring losses. And once this stage is over, then product goes into the next stage, which is market development and launch stage. In that stage, revenue started to grow up, and obviously we need to understand the behavior of cost as well. And as we introduce the product to the market, the product then goes to the growth stage, and the sales started to grow, the profit started to increase, and then there is a point when profit and sales reach the saturation point, and that stage is called the maturity stage. And then the sales and the profit started to decline, and there is a time when the product exits the market. So this is the product life cycle and the profit and revenue during the different stages of the product life cycle. But the bottom line is this: every product passes through these stages of the product life cycle. Now, once again, we need to understand each stage individually. That's very important, because we may be asked to tell in an objective type question. We may be asked about these stages, so we should be able to name those stages and what different characteristics exist in those stages. So in product development phase, during this stage, the product is designed and developed, prototypes will be produced, manufacturing processes will also be designed, including any special machining required to make the product. At this stage, cash flow will be negative as there is no revenue. So that is what I was telling you in the diagram as well. But importantly, we are designing and developing the product and its prototype in that stage. So definitely that means a high level of setup cost will be incurred at this stage, including research and development cost, product design and building of production facilities. So there is a huge cost which is incurred in that stage. And if we are doing periodic costing, then obviously during this stage there will be huge cost. There is no revenue, so periodically we're having negative profits, and the manager may think that the product is not viable or the product is not successful. But the point is that we are incurring this initial cost, this huge initial cost, in anticipation of greater benefits in the period to come. So obviously in the next periods, when the product is being introduced and grows, the revenues will catch up the cost, rather revenues will bypass the cost, and we will be having more profits. So next stage is market development and launch stage. In this stage, the product is being released into the market. During this stage, marketing and promotion are high, and the company often invests the most in promoting the product and getting it into the hands of the consumers. So we're incurring huge marketing and promotion cost. It is in this stage that the company is first able to get a sense of how consumers respond to the market, if they like it or not, and how successful it may be. However, it is also often a heavy spending period for the company with no guarantee that the product will pay for itself through sales. So even in that stage, we are developing. In the prior stage, we were developing the product. Now we are developing the market. So for product development, there is huge initial setup cost. For market development, there is a huge marketing cost. And in the product development stage, there is no revenue. In market development stage, there is a revenue, but that is relatively very less, because initially we are capturing few consumers, and relatively the cost of promotions and marketing is very huge. However, we started to get an idea of the response of the market, so whether customers are liking our product or not, and whether our sales will increase or not. But the bottom line is this: in that period as well, we are having very little profits, or maybe negative profits. Costs are generally very high, typically, but there is typically little competition. The costs will be high because we have not yet achieved economies of scale. We are producing in small quantities because there are less orders. Very few customers knows our product. As the demand increases, we will produce in large quantities, and that will give us economies of scale. And that happens in the growth phase, where consumers increasingly buying the products, sales are increasing, so definitely production will increase, and we will then be having economies of scale. But as the market expands, competitors started to enter. And then, in order to beat the competition, the company may still invest heavily in advertising and production of the product. As the market expands, more competition often drives prices down to make the specific products competitive. However, sales are usually increasing in volume and generating revenue. So this is at this stage, basically, the revenue is increasing, sales is increasing, though we are still incurring more marketing costs just to beat the competition. But because we have already captured the market and our sales and our market share is good, at this stage the company is starting milking profits, and that profit it's increasing at this stage. Volume increases dramatically and unit cost falls. We all know this behavior of the cost, where as the volume increases, fixed cost per unit decreases and the overall cost per unit decreases. So here at this stage, the cost goes down, revenue goes up, and the profit started to rise. But to an extent, because for every rise there is a fall. So before falling, the sale tend to slow or even stop, which means that market becomes saturated. Pricing at this stage can tend to get competitive. Marketing at this point is targeted at fending off competition. Overall marketing costs may increase to increase competition. And at this stage, less successful competitors will be pushed out of the market because the market started shaking. Companies often begin innovative to maintain their market share. Now, only those companies will be able to gain the market share, or rather to retain the market share, which started to innovate and which started to differentiate. Variable cost per unit falls further due to economies of scale and learning effects. So overall, at this stage, we reach the peak, highest point, highest in terms of revenues, maybe lowest in terms of cost, but we are struggling to increase that point, and we are struggling to increase the profit, and the profit started to decline as we entered the next phase, which is the decline phase. In the decline phase, product sales drop significantly and demand decreases. The company product loses more and more market share. Marketing in the decline stage is often minimal or targeted at already loyal customers, and prices are reduced. Eventually, the product will be retired out of the market unless it is able to redesign itself to remain relevant or in demand. Production economies may be lost as volume falls. We no more be having economies of scale which exist in the growth stage, which still exists in the maturity stage. In the decline stage, as the volume drops, as the demand drops, as the company struggles to increase the demand, we lost our economies of scale, and the cost per unit increases as well as the marketing cost. So eventually the company start having losses, and eventually the product goes out of the market unless we make a lot of innovations and unless we come up with a replacement product, which is only possible if the company is investing heavily in research and development. So that is the product life cycle. Now, just for giving you example, there are two examples which are mentioned in this lecture. One is example of typewriter. Now, when first introduced in the late 19th century, typewriters grew in popularity as a technology that improved the ease and efficiency of writing. However, the new electronic technology like computers, laptops, and even smartphones have quickly replaced typewriters, causing the revenues and demand to drop. Now, most of us and most of this present generation might even don't know the typewriters, but before these computers, obviously, if you need to write electronically, then there was a machine just like the keyboard and the punch machine which used to type whatever key you strike. So it was not like computer, but then the typewriters were replaced by computers and laptops and smartphones. So overtaken by the likes of companies like Microsoft, typewriters could be considered at the very tail end of the decline phase, with minimal sales and drastically decreased demand. So we don't find nowadays we don't find typewriters selling. There might be very few sales of this product in today's market, which is overtaken by companies like Microsoft and companies which are selling the laptops. So unlike typewriters, which are now at the end of the decline phase, we have another example of electronic vehicles, which are nowadays at the growth stage of the product life cycle. They're not the decline stage, they're the growth stage. The rise of electric vehicles shows more of a growth stage of a product life cycle. Companies like Tesla have been capitalizing on the growing product for years, although recent changes may signal changes for the particular company. Still, while the electronic car is not necessarily new, the innovations that companies like Tesla have made in recent years are consistently adapting to new changes in the electric car market, signaling its growth phase. So we can see now more sales of the electric vehicles or the hybrid vehicles. So these electric vehicles demand as well as revenues increasing. So they are at the growth stage of the life cycle, unless the typewriters, which are nowadays at the very end of the decline stage. So if we understand this concept of the product life cycle and life cycle costing, we apply this concept and do a product life cycle analysis. Now, companies use product life cycle analysis, which means examining their product life cycle return, to create strategies to maximize the return over the product life cycle. So the basic aim is to maximize the product return over product life cycle. Now, the life cycle return is the difference between life cycle revenues and life cycle cost. So every company wants to maximize. So one of the reason companies do product life cycle analysis is that they come to know how much is the expected life cycle return, so that they can devise various strategies to maximize that. Now, these strategies may include strategies to increase the product revenues and strategies to reduce the product cost of the life cycle. So if your analysis tells you that life cycle revenues are less than the life cycle cost, which means you're not having life cycle returns, rather you're having life cycle losses, then you could do something to increase the revenues, or you could do something to decrease the cost. Now both things are possible, because right now we are before the launch stage. We have not yet launched the product. So what we can do is we can redesign the product, and we can reduce the cost, and we can devise various strategies to increase the product revenues as well, and we can work on the pricing strategies as well. So everything is possible, but the point is that unless we know in advance that our product is gonna give us less return over the entire life cycle, we cannot come up with solutions. We cannot come up with various strategies to cope with that problem. So life cycle analysis, what we are saying is, will result in better pricing in various stages of the life cycle, which obviously have implications for the comparative position of the company. So now the question is how we do it, and what are the mechanics of product life cycle analysis. So life cycle costing may be applied in 5 simple steps. Now, step 1 is to estimate the product life cycle. Now, whatever is the product, we have to estimate whether its life cycle is 4 years, 5 years, 10 years. Now remember, life cycle started from when the product is in the development stage and ends when the product is in the decline stage. So a product can be of 10 years of life cycle, goes through different stages, maybe 2 years in development, 3 years in growth, and then 2 years in maturity, and then 2 years in decline, for example. So different products have different product life cycles, and they goes through the different stages. Each stage timing may be different, but whatever it is, we need to first estimate the product life cycle. And then we need to estimate the life cycle cost. Now, in the previous slides, I told you that at different stages of the life cycle, the cost is different. Now, for example, in the initial stage of product development, there is huge fixed cost, and then in the introduction stage, there is still initial fixed cost, and production cost is also high because there is less economies of scale. But then as economies of scale comes in the growth stage, we come up with a decline in the per unit variable cost and the production cost. So the point is that different cost of marketing and production and research and development varies in the different stages of the life cycle. But whatever they are, we need to estimate the total life cycle cost, which means we need to accumulate all the cost, whether they are required for development or marketing or production or research or quality control. We need to accumulate all the cost over the entire life cycle. Once we accumulate life cycle costs, then we need to accumulate life cycle revenues, and by subtracting life cycle cost from life cycle revenues, we can estimate life cycle return. Now, once we know the life cycle return, then our next stage is to devise various strategies to maximize the life cycle return, and that is the whole purpose of doing product life cycle analysis. We want to maximize the life cycle return. Now, what are the implications? So, what are the benefits? Life cycle costing encourages management to plan the pricing strategy for the whole product life rather than on short-term basis. So in periodic costing, because we accumulate the cost for a period, so if the pricing is based on periodic costing, then we are basically relying on short-term information for the pricing of the product. Now, for example, if in this year the cost is high, we will set up high price. In the next year, if the cost is low, we will set low price. Now, however, in initial periods where the cost is high, we may have to set up a low price so that customers are attracted and they buy the product and demand is created. So if we set high price because the cost is high, we may be uncompetitive. So life cycle costing actually resolves that problem, and life cycle costing encourages managers to look into the life cycle cost, which is definitely then averaged out. Initial periods high, further periods low. So on the average for 5-10 years, we'll be having an average life cycle cost. So based on that average life cycle cost, management will be then able to better price the product, which will be more competitive rather than the short-term pricing based on periodic costing. Identifying the cost which will be incurred throughout the product life means that management understands the cost better and therefore enables management to control them better. Now, when we were learning activity-based costing, which is another advanced management accounting technique, one of the benefit is that we have better understanding of the cost, and better understanding of the cost means we are then better able to control the cost. The same benefit we have by applying life cycle costing. Through life cycle costing, because we have a better idea of the cost and we have better idea of the stages where these costs are incurred and how much they are incurred, so we have a better information about the cost, so we are in a better position to control the cost. And especially when we have not yet launched the product, so we are prior to the launch phase. So prior to the launch phase, we have the complete information about the future costs and the future revenues and the future returns. So we are now in a better position to control these costs and to maximize the revenue and maximize the return. By monitoring a product's revenues and cost on a cumulative basis over the life of the product, management is provided with more meaningful information for control that it would have by monitoring costs and revenues period by period. So that is what I was elaborating in the previous point as well. Furthermore implications. it is much easier to design out costs during the design phase of the product than to control out costs later in the product life cycle. So unlike periodic costing, where we actually launch the product and then periodically cost the product and then periodically set the price and then periodically devise strategies, here in the product life cycle analysis, before actually launching the product, we do all these calculations, and if there is life cycle loss, then or our life cycle return is less, then what we do is we try to design out costs. Now design out cost means we change the design of the product, and by changing the design of the product we can eliminate a lot of material and the processes and the labor costs and the overheads. All this is possible because we have not yet launched the product, which is not possible in the other formats. Decisions about whether to continue to develop and manufacture product will be based on more complete information when product life cycle is considered. Unlike periodic costing, where you make a decision on the basis of periodic profits, here in life cycle analysis, decisions whether to continue to develop and manufacture the product is based on more complete information. Now, more complete information means the information of the cost and revenues over entire life cycle. We are not making our decision on the basis of particular year and how does the product performs in a particular year. We are making this decision on the basis of the performance, the possible or the expected performance of the product over its entire life cycle. So that's the true meaning of success. Instead of measuring success or the profit in short run, we are measuring the success of the product or the profit of the product in the long run. And by focusing on the long run and focusing on the future, we have more detailed, better information that has implications for better pricing and better controlling and better planning and better decision making, which are the three key words of management accounting. So in order to understand the concept of life cycle cost, let's have a look at this demonstration question where I'm showing you how to calculate life cycle cost per unit. But life cycle costing is more than that. Obviously, life cycle analysis involves comparing life cycle revenues with life cycle costs and then devising strategies. And there is a whole lot of stuff I told you in the slides. But this is one part where we are just calculating life cycle cost, which is the main, which is like the backbone of the whole analysis. So there is a demonstration question on the left, and on the right, I will try to solve it. Fit company specializes in the manufactures of small range of high-tech product for the fitness market. They're currently considering the development of a new product, which would be the first of its kind in the market. It would take 1 year to develop, with sales then commencing at the beginning of second year. And the product is expected to have a life cycle of 2 years before it is replaced with a technologically superior product. The following cost estimates have been made. So this is the information about the product. So information is categorized into 3 years. So first year is of research and development, and then in the next 2 years, the product is then launched. There is a whole lot of information. But I will go straight into the workings, calculate the life cycle cost per unit. So what we need to do is we need to calculate life cycle cost per unit. So first I will be calculating the life cycle cost in total. So what I will do is I will accumulate all the costs. So that's the concept. Life cycle costing accumulates all the cost over the entire life cycle. So I will take each cost in turn. So like the first cost is research and development cost. So I will take this research and development cost . So you can see there are 3 costs mentioned here. in research and development, in year 1 this is 160. So there is only one cost, research and development, and that is in year 1 only, 1,60,000. There is no research and development cost in subsequent years. So accumulating them means it is 1,60,000. So the next cost which is given is product design cost. Product design cost. The product design cost is given as 800,000 in year 1. There is no product design cost subsequently. So the total of product design cost for the entire life cycle is 800,000. And then we are given marketing cost. And marketing cost 1.2 million in year 1, 1 million in year 2, and 1.75 million in year 3. So here we need to accumulate this. Marketing cost. So I will accumulate these together. So that becomes 3.95 million, which is 39,50,000. And that is a total of 12 lakh and 10 lakh and 17,50,000. And then we have manufacturing cost. Now in the question we have two types of manufacturing cost. One is variable and the other one is fixed. Now for variable, now fixed is simple because in fixed we just need to add them together. Now fixed is 120, 120, so if we accumulate them that becomes 240, so that's simple. For variable, what we need to do is we need to multiply variable cost per unit 40 with the number of units 100,000, so that becomes 40 lakh. So this is for year 1. And then I need to multiply the variable cost per unit in year 3 with the number of units. So 42 times 200,000. So let me just calculate this. 200,000 times 42. So that becomes 84 lakh. And adding them together, it becomes 124,000,000. So this is the total of the variable manufacturing cost. Likewise, we have distribution cost. Again, we have variable and fixed both. Again, fixed is simple. We'll be adding the two costs together. 120. Okay, I guess I made some mistake. This is 120, 120 for the distribution cost, so that makes it 240. I erroneously take this 240 in manufacturing cost as well. In case of manufacturing, this is 650 and 1290. So let me just correct that. 650,000 plus 1290,000. So total fixed production cost is 19,40,000 and distribution is 2,40,000. Now for variable distribution, what we need to do is we need to multiply 4, which is variable distribution cost per unit in year 2, with 100,000, and then 4.5 with 200,000. So in total, variable distribution cost becomes 13 lakh. Then finally, I need to add administration costs. And administration cost is given as 900,000 and 1,500,000. So that is 2,600,000. There is no variable administration cost. So if I add all these costs together, that becomes 24690,000. So this is what we call, we accumulate all the cost over the entire life cycle. We accumulated the research and development cost and the product design cost and marketing cost and distribution cost and selling cost, and the total of the cost over the entire life cycle is 24690,000. Now the requirement was to calculate life cycle cost per unit. So as a final step, we need to divide this total of life cycle cost by the total number of units, and total number of units are 300,000. So they're given 100,000 year 1, year 2, and 200,000 year 3. So this is 300,000. So that means our answer is $82.30. So the life cycle cost per unit is $82.30. Now mind it that if I calculate this periodically, like if I just calculate cost per unit in year 2 and if I calculate cost per unit in year 3, it would be entirely different. But this is the cost per unit once we accumulate all the cost over the life cycle and we divide it by the number of units over the life cycle. So what we are saying here in this concept, we are saying here is that this cost is a better, this way of calculating cost incorporates all the information. It gives us better understanding, and by comparing it with the revenue over the life cycle, we can calculate the life cycle return. And if life cycle return is less, we can devise various strategies which can include reducing one of these costs or most of these costs, and increasing the revenue of the product with the objective of maximizing the product life cycle return. So that's the concept, and that's one of the application of the concept. In the next couple of lectures, I will be doing some multiple choice questions and some OT cases to give you more variety of how this could be asked in the exam, and with different applications of the concept of life cycle costing. So children, stay tuned. Bye bye.